In Investing 101 today, Marc Horner of the $1 Million Cup of Coffee joins me now, and he's back on the show. We should probably explain why you call your company the $1 Million Cup of Coffee, just quickly in a sentence.
Sure, real quickly, it's just compound interest. So it's an example to help young people understand the power of compound interest. You start saving the equivalent of a cup of coffee a day at age 20, you're basically going to be a millionaire by the time you retire.
Easy way to get rich. Let's talk about how the rest of us, if we're not in the millennial stage, can actually make some money as well. We're taking a look at averages now, but everybody talks about how the stock market goes up and you're basically almost guaranteed that you're going to get some sort of return on your investment. And a lot of people say it's going to be 10%, but you say that these averages can be misleading. Why is that?
Very misleading. So the long-term average return for the S&P 500 is about 10%, but since 1926, it's only returned between 8 and 12% 6 times. So that's 6 times in almost 90 years. So investors going into an investment in the S&P expecting to get the long-term average annual return almost never get it.
Wow.
They get up 15, down 6, and it's all over the board.
But it's still worth investing in the stock market.
It absolutely is, but it's important to go into that investment with the right expectations. So investors looking again at that long-term average annual return can get easily frustrated if they never actually get that return. But you need to stick with that. You need to stick with that investment through the ups and the downs. And the media, present company excluded, make that a little bit more difficult because you hear language about the markets are plummeting or the markets are skyrocketing, and so that can make somebody a little uncomfortable with their investment. So again, it's just important to understand what it is that you're getting yourself into, and then stick with it.
That's what I do. I just pick the stocks or ETFs. I'm very diversified, and I leave it alone. I don't look. Sometimes I get my statement and it's a little down. Sometimes I don't even open my statements, but I know that long term, everything is going higher. And there have been some very good years and some not so good years, but you're right, it all seems to kind of average out, and we have always been trending higher with the market.
We have, and so maybe a helpful example for people that aren't familiar day to day with the markets is here in Chicago, the average annual temperature is about 49 degrees. But anybody that lives in Chicago knows the summer's a lot warmer and the winter's a lot colder. So you populate your closet with clothes that are going to help you throughout the course of the year, and you do the same thing in your investment portfolio, just like you're doing, different types of investments to stay diversified.
As a true Chicagoan, 49 degrees is not bad. I'm sure other people in other states are going, oh, that's cold, but to us it's like, okay, it's a pretty good day.
That's not bad. That's not bad, but a wide range of averages through the course of the year.
Well, good to have you here talking about investing our money. Thank you, Marc.
Thank you, Angie.